Well, Cornelia Meyer is an economist. She joins us from Bern in Switzerland. Thank you very much for being on Al Jazeera. How necessary do you think this deal was?
Well, I think it was absolutely necessary. And it was the best of very few solutions. It's not an ideal solution, but it's the least bad solution. You know, the other solutions would have been to let the bank go bust, which had huge ramifications both in the global financial system and in the Swiss economy as a whole, not just the financial sector, or to nationalize the bank. So this was the most elegant and the least bad solution.
Do you think it's going to quell the turmoil or stem the global crisis of confidence in the banking sector?
Well, I hope it will stem at least the confidence in Credit Suisse, UBS, and the Swiss system. But you know what we're seeing on the other side of the Atlantic in the US is there are quite a bit of rumblings, but they're different in nature, because if you look at Credit Suisse, they were well capitalized, and until so many deposits went out, they also had no liquidity issues. You look at the banks in the US who have issues. They have issues because of liquidity concerns, because of capitalization, and because, especially with SVB, because they were caught on the wrong end of rising interest rates. That was not the case with Credit Suisse.
OK. Well, what do you think this has done to the credibility of the Swiss banking sector, do you think?
Well, it's not good. Let's put it this way. It's not helpful if your second largest bank, which is one of 30 too big to fail banks in the global banking system, can go down so quickly overnight. That's clearly not good. What I would also say, on the other hand, though, it showed that when the regulator, the national bank, and the government work together closely, within 4 days, you find a solution. So yes, it shows that they found a solution. This is very good. It should never have gotten there. But these problems, the problem with Credit Suisse is not just the problem of now. It's a problem that has been, in the making since about 1990, when the bank bought First Boston, which had a risk profile they couldn't deal with. And then they sort of had a series of CEOs who sort of wanted to play big on the international markets, not looking at the heritage of the bank. So what you saw here is, then you had a bunch of scandals. So you had a new strategy after strategy after strategy, and nobody ever had the time to implement the strategy they had come up with.
Obviously, the timing of this announcement's important ahead of markets opening tomorrow. How do you think that they are going to react?
Well, I hope. I mean, look, who knows? But I hope Asia is opening about now-ish. I hope they will react well. I mean, it must be a sigh of relief. We all thought, actually, I personally also thought that when the Swiss National Bank came out with the $54 billion or Swiss franc backstop middle of last week, I thought that would be enough, but it clearly wasn't. So I hope this will be enough. But this is not going to be easy. It's going to be tough on Credit Suisse. It's going to be very tough on UBS. Usually, when you have such a major takeover or merger, that's something that's in the making for many months, and a lot of careful plans are drawn up. That's not the case here.
Wasn't the clampdown and the regulations that were put in place after the 2008 global financial crisis, wasn't that meant to deal with a lot of these problems and I guess stop them from happening again?
I think it was. And when I look at it, when I look at the capitalization of Tier 1 capital, Tier 2 capital, Credit Suisse was well capitalized. The liquidity crisis happened when there was the when there were more and more people who had deposited money in the bank, withdrawing the money in the bank. So, no bank can live without the confidence of its depositors and investors.
OK, we'll have to leave it there. Thank you so much for your time. That is Cornelia Meyer, an economist out of Bern, Switzerland. Thank you.
Thank you very much.